A staggering 95% of investors underperform the market. This statistic is not just a testament to the unpredictability of the financial world, but also a reflection of common behavioral pitfalls, lack of diversification, and frequent trading that many fall prey to. As the allure of beating the market tempts countless individuals, the majority find themselves caught in a cycle of decisions that often result in missed opportunities and diminished returns. Today, I'm going to go over the top 10 most common mistakes professional investors make that lead them to underperform the market. This is why I tend to invest most of my capital in index funds. I buy, then forget, never ever planning on selling until I am in my retirement years. This is probably the best choice for most amateur investors. That being said, it is still very illuminating to learn about the mistakes that people make that lead them to underperform the market. Before we delve deeper into this subject, kindly check the description below for a selection of top-notch books that have been instrumental in my financial journey. By opting to purchase a book through any of the links below, you're also bolstering this channel, enabling me to craft more content that you love. On that note, let's get started. Number 1. Timing the market. Trying to time the market is a perilous endeavor, often more rooted in emotion than in prudent financial strategy. The central flaw in attempting to predict market movements is that it relies on perfect foresight, a quality no investor truly possesses. The assertion that there are two kinds of people in regards to market timing underscores the inherent unpredictability and complexity of financial markets. Those who believe they can precisely forecast the market's ups and downs usually fall victim to overconfidence, potentially leading to hasty decisions and compromised returns. On the other hand, the sheer number of variables affecting market movements, from geopolitical events to technological breakthroughs, makes it nearly impossible for anyone to consistently predict its trajectory. Hence, a long-term, disciplined investment strategy often proves more fruitful than the elusive chase to beat the market's ticking clock. Number 2. Making investment decisions based on news. Making investment decisions based solely on recent news is akin to navigating treacherous waters without a compass. News outlets primarily focus on capturing attention and not necessarily on providing nuanced financial advice. By the time an investment tip reaches mainstream news, it's often already been acted upon by institutional investors, making it less profitable for the average investor. Relying solely on the news can lead to reactive and short-sighted decision-making, influenced by the sensationalism and immediacy of the media cycle. The most successful investors, on the other hand, are independent thinkers. They understand the value of comprehensive research, long-term strategy, and the wisdom of not getting swayed by the ebb and flow of current events. To achieve consistent returns, one must learn to separate the noise from the signal and make informed decisions, rather than riding the wave of the latest headlines. Number 3. Not staying within your circle of competence. Venturing beyond one's circle of competence in the investment world can be a risky proposition. Renowned investors often advocate for the principle, invest in what you understand. This wisdom is not just a catchphrase, it's a vital guideline for sustainable financial success. When one invests in companies or industries they don't fully grasp, they're flying blind, unable to differentiate temporary setbacks from fundamental flaws. Moreover, without a deep understanding of a company's operations, competition, and market positioning, an investor cannot accurately assess its potential or risks. This lack of knowledge can lead to ill-timed decisions, like holding onto a plummeting stock or selling a promising one prematurely. Staying within one's circle of competence ensures that investment decisions are made with clarity, confidence, and insight, rather than being dictated by market whims or hearsay. In essence, knowledge not only powers returns, but also shields against unnecessary losses. Number 4. Trading too much. Trading excessively is a common pitfall that can erode an investor's returns more stealthily than they might realize. Each trade incurs costs, and frequent trading amplifies these expenses, which can significantly dent overall portfolio returns over time. The adage, investors make money for themselves, traders make money for their brokers, succinctly captures this dynamic. While it's an oversimplification, the underlying message is clear. High-frequency trading often benefits intermediaries through commissions and fees rather than the traders themselves. Moreover, constant trading can be a manifestation of a reactive rather than a strategic mindset. Chasing short-term gains or panicking in volatile markets often results in decisions driven by emotions rather than careful analysis. In contrast, a long-term, patient approach tends to produce more stable returns and allows compound interest to work its magic. It's essential for investors to distinguish between making informed adjustments to their portfolios and being lured into the frenetic world of overtrading. Number 5. Worrying too much. The financial world, with its inherent unpredictability and volatility, offers plenty of reasons for concern. However, excessive worrying can cloud judgment and lead to hasty decisions. While it's said, there is always something to worry about, it's crucial to differentiate between transient market jitters and genuine, long-term threats. The best investors often display an inherent optimism, not based on naivety, but on a deep understanding of market cycles and the historical resilience of economies. By focusing on the long term, these investors are less swayed by short-term market dips or news-driven panic. Instead, they see such moments as opportunities or necessary corrections. Being perpetually anxious can lead to missed investment opportunities or premature exits from solid positions. In contrast, an optimistic, forward-looking approach, tempered by diligent research and analysis, positions investors for sustained success. Number 6. Herd behavior. Herd behavior, or the tendency to follow the majority's actions without independent analysis, can be a precarious path in the investment world. When investors rush to buy or sell assets based solely on what everyone else is doing, bubbles can inflate and crashes can ensue. The principle, "if you want to perform better than the market, you need to do things differently," underscores the value of independent thinking in investment decisions. Merely mirroring the crowd often results in mediocre returns at best. Instead of being swept up in market euphoria or panic, astute investors focus on fundamentals. They seek out wonderful companies trading at fair prices, relying on thorough analysis rather than popular sentiment. This disciplined approach not only provides a buffer against market volatility, but also positions them to capitalize on mispriced opportunities that the herd might overlook. In the world of investing, the wisdom of the crowd can sometimes be a mirage. True success lies in discerning vision and unwavering diligence. Number 7. Ignoring fundamentals. Ignoring the fundamentals in investing is akin to building a house on shaky ground. While market sentiments, trends, and speculations can drive short-term stock movements, in the long run, it's the fundamentals of a company that determine its intrinsic value and potential for growth. The maxim, "in the end, the fundamentals of the company are all what matters," is a timeless reminder of this truth. Stocks aren't just ticker symbols. They represent ownership in real businesses with tangible operations, assets, liabilities, and growth prospects. Astute investors understand the importance of delving deep into a company's balance sheet, assessing its profitability, and identifying ample reinvestment opportunities. Such diligent analysis ensures investments are grounded in reality rather than mere hype or momentum. By prioritizing companies with solid fundamentals, investors increase the likelihood of achieving sizable returns, thereby shielding their portfolios from the whims and volatilities of an ever-changing market. Number 8. Emotional decision-making. Emotional decision-making can be the Achilles heel of even the most seasoned investors. The stock market, with its inherent volatility, can trigger a roller coaster of emotions, from euphoria during bull markets to despair in bearish times. Acting on these emotions, however, often leads to impulsive and ill-timed decisions. The mantra, "never buy or sell a stock based on your emotions," is a beacon of wisdom in this context. Emotions can cloud judgment, obscure rational analysis, and distort our perception of risk and reward. On the other hand, rationality in investing demands a clear-headed evaluation of fundamentals, market dynamics, and long-term prospects. By maintaining a calm and analytical mindset, investors can navigate the market's ebbs and flows with discernment, avoiding the pitfalls of panic selling or exuberant buying. In the intricate dance of investing, it's the steady, rational steps that lead to enduring success, not the impulsive moves driven by fleeting emotions. Number 9. Trying to predict the economy, interest rate, or stock market. Attempting to forecast the broader economy, interest rates, or the trajectory of the entire stock market is an endeavor fraught with uncertainty. While these macroeconomic elements play a role in shaping the financial landscape, their complex, interconnected nature makes them inherently challenging to predict with consistent accuracy. The advice, "don't focus on macroeconomic factors to make investment decisions," stems from this unpredictability. Instead, a more actionable and grounded approach for investors is to concentrate on individual companies and their intrinsic value per share. By honing in on this metric, investors can assess the true worth of a company, independent of current market price or transient economic trends. Evaluating factors such as a company's earnings, assets, liabilities, and growth potential provides a clearer picture of its long-term viability and value proposition. In essence, while the broader economic winds may be unpredictable, a steadfast focus on the fundamentals of individual companies offers a more navigable path to investment success. Number 10. Focusing on the short term. Lastly, in the world of investing, a myopic focus on the short term can be a recipe for volatility and missed opportunities. Constantly reacting to immediate market fluctuations often results in decisions driven by fear or greed rather than sound financial analysis. The cautionary advice, "when you focus on the short term, you are doomed to fail," underscores the pitfalls of this short-sighted approach. Instead of being swayed by the transient movements of stock prices or quarterly earnings, visionary investors adopt a broader horizon. The principle of not thinking in quarters, but in quarter decades speaks to the power of compound interest, the advantages of long-term growth, and the inherent cyclical nature of markets. Over extended periods, solid companies tend to appreciate in value, dividends get reinvested, and temporary market setbacks become mere blips on a longer growth trajectory. Adopting such a long-term perspective not only helps investors weather the storms of market volatility, but also positions them to reap the benefits of enduring value creation. Investing, at its core, requires a blend of discipline, patience, and clarity of thought. The challenges of timing the market, making decisions based on fleeting news, venturing outside one's circle of competence, excessive trading, succumbing to herd behavior, and letting emotions dictate decisions can erode returns and compromise financial goals. If you've enjoyed this video, consider liking and subscribing to the channel. Until next time, keep calm and compound on.